Welcome back to the channel. Today's video is not hype, not motivation, and not a promise of easy money. This is a reality check video. We're going to slow everything down and talk honestly about one of the most popular income ETFs in the world, SCHD. A lot of people mention it casually and say things like, I'll just live off dividends or SCHD will pay my bills someday. But very few people actually sit down and run the numbers properly. That's exactly what we're doing today. No shortcuts, no exaggeration, just math and logic explained in plain language. By the end of this video, you'll clearly understand what SCHD is, why people use it for income, and how much money it truly takes to live off its dividends alone. This video is for informational purposes only and is not financial advice. Always do your own research or consult a professional before making any investment decisions. Before we touch any calculations, we need to understand what SCHD actually is, because the structure of an investment matters just as much as the returns. SCHD stands for the Schwab U.S. Dividend Equity ETF. It was launched back in 2011, and its purpose is very straightforward. It is designed to track the Dow Jones U.S. Dividend 100 Index. That index is not random, and it's not built for excitement. It focuses on about 100 U.S.-based companies that have a strong track record of paying dividends, and more importantly, the financial strength to keep paying them in the future. The companies inside SCHD are not chosen just because they pay dividends. They are filtered through multiple quality screens. These screens look at things like consistent dividend payments, healthy cash flow, manageable debt levels, and overall financial stability. This is why SCHD is often described as a quality dividend ETF. It is not chasing the highest yield available, and it's not designed to swing wildly in price. Instead, it aims to provide steady, dependable income over long periods of time. That design choice is what attracts income-focused investors, especially those thinking about retirement or long-term cash flow. Another important detail that often gets overlooked is SCHD's expense ratio. The fund charges just 0.06% per year, which is extremely low. That means very little of your dividend income is lost to management fees. Over decades, that difference matters more than people realize. SCHD also pays dividends quarterly, not monthly. That might sound minor, but it affects how people plan their cash flow. This ETF is built for patience, not instant gratification. In simple terms, SCHD is designed to deliver reliable income slowly and consistently, not aggressively or dramatically. Now that we understand what SCHD is, we need to talk about dividend yield, because every income calculation depends on this single number. Recently, SCHD's dividend yield has been floating roughly between 3.4% and 3.6%, based on its trailing 12 months of dividend payments. But here's something many investors misunderstand. Dividend yield is not a fixed number. It moves up and down as the ETF's price changes, and it also changes as dividend payments increase or decrease. Instead of picking the highest number to make the math look attractive, we're going to use a realistic and conservative assumption. We'll use a 3.5% yield as our baseline. This matters because optimistic assumptions can give you false confidence. Using a slightly lower, more grounded number helps create a plan that survives real life, not just spreadsheets. And it's important to say this clearly. Dividends are not guaranteed. Even strong funds can reduce payouts during difficult periods. SCHD has an excellent history, but history is not a promise. So for the rest of this video, we're locking in a conservative 3.5% yield and moving forward with no optimism baked in. Next, we need to define what living off dividends actually means, because people use that phrase very loosely. In this video, living off dividends means your dividend income fully covers your yearly expenses without selling any shares and without touching your original investment. No side income, no withdrawals, no asset sales. Just dividends paying the bills. That's a strict definition, but clarity is necessary if we want honest math. Expenses vary widely depending on lifestyle, location, and personal choices. So instead of guessing, we'll use 4 realistic spending scenarios. First is $30,000 per year. This represents a very modest lifestyle, likely in a low-cost area with minimal spending. Next is $40,000 per year, which reflects a basic but reasonably comfortable lifestyle for a single person in many parts of the U.S. Then we move to $50,000 per year, which aligns with average living costs for many individuals today. Finally, $60,000 per year represents higher living expenses or supporting a household. These numbers are not recommendations. They are reference points so the math can speak clearly. Now we reach the core calculation, and this is where many people feel uncomfortable. The formula itself is very simple. You take your annual expenses and divide them by your dividend yield. That's it. There's no trick. Since we're using a 3.5% yield, let's start with the lowest example. If you need $30,000 per year, you divide 30,000 by 0.035. That results in approximately $857,000. That's the minimum portfolio size needed before taxes and before inflation. When we move up to $40,000 per year, the required portfolio jumps to around $1.14 million. For $50,000 per year, the number increases to roughly $1.43 million. And for $60,000 per year, you're looking at about $1.71 million invested in SCHD alone. This is usually the moment when people pause the video, rewind, and check the math again. But the math is correct. Dividend income feels passive, but the capital required to generate it is significant. Most people don't have an income problem, they have a math problem. And remember, these numbers assume you never sell shares and that the yield remains stable. They also ignore taxes, which we absolutely cannot ignore. SCHD dividends are mostly qualified dividends, which is good news because they're taxed at lower rates than ordinary income. Depending on your tax bracket, that rate could be 0%, 15%, or even 20% at the federal level, with state taxes potentially adding more. Let's look at a simple example. If SCHD pays you $40,000 per year in dividends and your effective tax rate is 15%, you don't actually keep $40,000. After taxes, you're left with about $34,000. Your expenses didn't change, but your usable income did. That means if your goal is to spend $40,000 per year, you need more than $40,000 in gross dividends. This is why ignoring taxes leads to underestimating how large your portfolio needs to be, and many people make this mistake. Now we have to talk about inflation because time changes everything. Inflation slowly erodes purchasing power. What costs $40,000 today will cost more in the future. Historically, inflation averages around 2% to 3% per year, though some years are higher and some are lower. This is where dividend growth becomes important. Historically, SCHD has grown its dividends at a healthy rate, often cited around 9% to 11% depending on the time frame. That growth can help offset inflation over time. But here's the balance. Dividend growth is not guaranteed and it's not consistent. Some years are strong, some years are flat, and some years slow down. Dividend growth helps, but it does not eliminate risk. That's why the starting portfolio size matters so much. Growth helps later. Capital matters first. Capital. At this point, the numbers might feel heavy, and that's okay. This video answers one specific question. What is the lowest amount needed to live off SCHD dividends alone? It does not claim this is the easiest path or the fastest strategy. Living purely off dividends without selling shares is a strict rule, and strict rules require more capital. Other strategies, like combining ETFs, allowing partial withdrawals, or reducing expense targets, can lower the required amount. But under this definition, relying only on SCHD dividends, this is the math. Let's bring everything together. SCHD currently yields around 3.5%, which we used as a conservative baseline. To generate $30,000 per year, you need roughly $850,000 invested before taxes. For $40,000 per year, you need about $1.14 million. Higher expenses require even more capital. Taxes reduce what you actually keep. Inflation increases future costs. Dividend growth helps, but it's not guaranteed. There is no shortcut around these realities. This doesn't mean SCHD is a bad investment. It means it's an honest one. If you understand the math, you can plan realistically instead of relying on hope. And that's the real purpose of this video. Not to scare you, but to give you clarity. Thanks for watching. If you found this helpful, don't forget to like, subscribe, and hit the bell so you don't miss any updates. See you in the next video.